companies that typically use LIFO, or the retail inventory method, to value their inventory, FASB has an exception to the lower of cost or net realizable value that these businesses can use to value their inventory. It is the lower of cost or market. I'm going to put market in quotes because what this really means is a designated market value. We know what cost is. Let me talk about this market value for a minute. The designated market value is the middle of these three values. The first is net realizable value. We know what that is from our lower of cost or net realizable value. It's our estimated sales price minus our estimated cost to sell it, estimated cost to complete it. We will also consider replacement cost. What would it cost today to replace this inventory? This is going to be different than the original cost that we paid for it. And finally, the other or third value that we'll consider for the designated market value is net realizable value minus a normal profit margin. So you can think about this, it's likely that this is going to be the lowest among these three. Normally, if net realizable value is our estimated selling price minus cost to complete, minus cost to sell, and here we're subtracting one more component, less our normal profit margin. Let's take a look at an example in the handout. This one is BE94. We have a company here that's using LIFO, and so we're going to value inventory at the lower of cost or market. And you can see in the handout that this company has three different products: skis, boots, and parkas. It asks us to pinpoint the cost component that should be used to value in lower of cost or market, and then it asks us to pinpoint the market value. So let me do this first for boots. All right, so we see here that the historical cost for boots, or original cost, is $106. This is the figure that we're going to be comparing to our designated market value. Let's look at those three market values and choose the one in the middle. So first is net realizable value. This is the boots selling price, estimated at $145, minus selling cost or cost to complete. Here we have cost to distribute. That's a selling cost. It's $8. So our net realizable value is $137 per item. How about replacement? Our current replacement cost for boots is $105. And then this last one, our net realizable value minus a normal profit. So I'm going to take our net realizable value from above, and it says that our normal profit margin for boots is $29. We arrive at $108. So we've got $137 for net realizable value, $105 for replacement, and $108 for net realizable value minus our normal profit margin. This is the middle of those three values. Step two, we compare this to cost. Which one's lower? In this case, the original historical cost for the boots, what we paid for them, is the lower of cost or market value. Therefore, we would choose $106, multiply that by the number of units we have, and apply that figure in the balance sheet for boots inventory. All right, let's do another problem that centers on the lower of cost or market. But before we do that, I just wanted to offer two reminders. The first is we usually take a conservative approach, of course, and choose a lower value for inventory on our balance sheet. And this is a reminder to say that if there's a situation where inventory increases in value after we have recorded a loss, we cannot record an increase or bring inventory up past the value that we paid for it, okay? We can't recover losses above original cost. The second reminder is the expense recognition principle. Why are we doing this now? Well, we're doing this now because the future value or the future utility of this asset, inventory, has declined now. And therefore, we're going to record this loss in the period in which we've incurred this loss. Let's get into this problem. It is in the handout P9-4. We've got a home improvement company. This is at the end of May, as of May 31st, and it uses the LIFO inventory costing method. We're given 4 products. We have them here: aluminum, cedar, glass, and thermal windows. And we have cost, replacement cost, and other values. The question asks us to determine the proper balance in the allowance to reduce inventory, determine the gain or the loss associated with examining this from a lower of cost or market value. And then it tells us that there is an existing balance in that allowance account to reduce inventory, and this is credit balance of $27,500. So how we're going to go at this is, let's determine what inventory should be in terms of the value we should be carrying it on the balance sheet. And then we will make the journal entry, and I think that'll take care of the answers to these questions. So first, let's look at this first product. It says, and this is total cost, this would be all the units. We have $70,000 in cost. So let's determine this designated market value. We've got a replacement cost here, $62,500, net realizable value of $56,000. And then it tells us that our normal profit on this aluminum product is $5,100. So I'll go over here to this column, this net realizable value minus profit, and that comes to $50,900. When we apply the same thing to these other products, for cedar, the net realizable value minus profit is $77,400. For glass, it's $149,800. And for windows, it's $124,600. So now let's select the lower of cost or market. I guess before we do that, let's pinpoint the designated market value, okay? So we know what cost is, and then I'm going to circle the answer among these three to designate the market value, which is the middle value of these three market values. So for aluminum, our designated market value is our net realizable value of $56,000. For cedar, it looks like it's going to be replacement cost, $79,400. For glass, it's going to be the net realizable value minus profit, which is $149,800. And then for thermal, we will use the replacement cost as our market value. So now we have our designated market value. Let's select the lower of cost or market value. So for this first one, aluminum, we're comparing the cost of $70,000 to our designated market value of $56,000. And the lower value between those is $56,000. For the next one, cedar, we're comparing $86,000, what we paid for it, against our designated market value of $79,400. $79,400 is the lower value among those two. The third one, cost minus our designated market value. You can see that our cost of $112,000 is certainly less than our designated market value of $149,000. And the fourth one, our lower between market value and cost is going to be that replacement cost, our designated market value of $126,000. When we add up these four lower of cost or market value, we arrive at $373,400. Look at this. Now we've got our total cost, $408,000, compared to what we should be carrying the inventory at, which is $373,400. We're making progress on this. So let's determine what the journal entry should be. We got to consider what our allowance account is, because we're starting with a balance in there. This is our allowance to reduce inventory account. That nice segregated line in the balance sheet so we can, as users, see what's truly going on. Here we're starting with a balance of $27,500. All right, let's think about these two now. We have original cost. This is what we're carrying the inventory at on the balance sheet of $408,000. This is the lower of cost or market, $373,400. We've got a difference here of $34,600. That should be the balance in the allowance account, right? Because visualize this, you'd have your original cost of $408,000. Then you'd have less the allowance to reduce inventory of $34,000, and that would give us what inventory should be, and we've determined that to be $373,000. So with that understanding, I'll move over to our T account, and I'll just offer this should be the balance. So what journal entry do we need to make here to reduce inventory to the net carrying value that it should be? Well, if we've got this balance that it should be, and we've got $27,500 already in the allowance account, that difference is $7,100. So let's take care of this journal entry, and this will get us to the point where we need to be. Our loss due to decline in inventory for this period is $7,100. What's the effect on the income statement? This decreases net income. Let's take care of the credit. This is our allowance to reduce inventory, this is going to be $7,100. What's this going to do? It's going to increase our allowance account, which is going to decrease our carrying value of inventory down to where it should be at $373,400.